and welcome to this week's edition of Echo45 Advisors Market and Economic Update. In this video, we'll discuss what's been happening beneath the surface of the stock market, specifically how different sectors have been performing and what it means for your portfolio. Most investors are familiar with the broad market indices like the S&P 500 or the Dow, but looking one level deeper at the 11 sectors that make up the S&P 500 can tell us a lot more about what's really driving the stock market performance. This year, the gap between the best and worst performing sectors has widened to over 40 percentage points. Let's walk through why this is happening and what it means. First, the energy sector has been the standout performer of this year, gaining around 30% year to date. The main driver has been a sharp rise in oil prices, with Brent crude hovering above $100 per barrel as tensions in the Middle East have escalated. We've seen this pattern across history. When Russia invaded Ukraine in 2022, the energy sector gained nearly 66% for the full year, even as the broader S&P 500 fell 18%. Higher oil prices directly benefit energy producers, boosting revenues and encouraging further investment. At the same time, elevated oil prices can act as a headwind for the broader economy by raising costs for consumers and businesses. That said, history suggests that these supply-side shocks tend to be temporary. For instance, the market began to recover quickly by the end of the 2022 episode. Next, let's talk about technology. Over the past several years, AI-related stocks have led the market, but more recently, that leadership has shifted. While many of these companies continue to post strong earnings, questions have emerged about how AI tools might disrupt traditional software. Some have called this dynamic the SaaSpocalypse, since the term SaaS is used to refer to the software as a service business model. Whether or not those concerns are proved justified, they have contributed to a reassessment of technology valuations. That doesn't mean technology is no longer important, far from it. What it does illustrate is how quickly market leadership can change. This is why becoming overly concentrated in a single group or sector can create real portfolio risk. Finally, as uncertainty has increased this year, investors have rotated toward more defensive sectors like utilities, consumer staples, and healthcare. These sectors tend to hold up better during periods of volatility because their cash flows are more stable and less dependent on economic cycles. A related idea that has gained attention is the concept called HALO, which stands for Heavy Assets, Low Obsolescence. These are companies that rely on physical assets or manufacturing that are less easily disrupted by new technology. As this chart shows, sector leadership rotates frequently. The top performer one year can easily become a laggard the next. This unpredictability is exactly why broad sector diversification matters. We hope you found these insights helpful. If you would like to discuss broad sector trends, market dynamics, or your portfolio and how it's positioned across different parts of the market, please don't hesitate to reach out. We look forward to speaking with you soon.